Then when you talk to your clients, and you talk to a prospect, and you go out to this law firm, or you sit down, what's the most important thing? You say, what are your investment objectives? Really, what's your risk tolerance? What's the most likely thing a person's going to say?
I don't go out to appointment time unless I know I have a copy of the entire menu of options. I put them in the portfolio management tool, or I put it now in the team builder too, so I know what I got going in, as far as where they are and where they should be. And I just go back and I start most of my presentations in March 2000. You can assume a few things from March 2000. The guy's fully invested. He's probably 50 to 75% weighted in large cap mutual funds or clones to large cap mutual funds, which, as you know, have a minimum of 82% correlation to the S&P 500.
82, it's 88.
Is it 88 now?
If you took all equity mutual funds and put them into a goldfish bowl.
All equity, okay.
All equity.
Oh, I thought it was just large cap.
No, if you took all equity mutual funds and put them into a goldfish bowl,
right,
that goldfish bowl will correlate to the S&P 500 by 88%.
88%, yes. And they don't know that. They also have no idea the statistics of the MU100. That MU100 and the MU500 have opened just about every account I have.
Explain what you mean by that.
Well, the correlation...
The MU100 is...
The 100 most...
largest.
Steve updates it every quarter. Right. So you just got the September 30 numbers in there now. Pfizer just went to number 1. It was number 2 or 3 last quarter.
And there's a stock that has done
the number 1
nothing.
Holding of every, and it's gone. And GE's number 3 or 2, and GE used to be number 1.
Also a burned out star.
Just terrible.
That's a burned out star.
The fact that 72% of all the money invested in mutual funds, and this is domestic, same figure, same universe you just used, is in the same 500 stocks, and 43%, I believe it is now, is invested in the same 100 stocks.
Same 100 stocks,
same
43%.
If you just used the S&P bullish percent, equal weighted or whatever you wanted to use, the MU100, the MU500, and looked at the relative strength on a mutual fund, you could manage anybody's portfolio in that you would ever come across. A lot of emails and calls I get, how do you keep all this straight with all these clients? You're just using the tools on the Dorsey Wright database that correlate to what you got in the mutual fund menu. So I just go back to March 2000 and say, okay, when the indicators began to turn, when you had 98% of all large cap growth funds on a buy signal in February of 2000, and that reversed down and went eventually below 70% in late March, early April of 2000, you needed to do something. In addition to all the other market indicators that you know from the stock market side, that the risk was high and they're taking air out of the balloon here.
And one of the most important calls that you could have made for 401k, and I mean, if you just made this one call,
exactly,
October of 2000, the relative strength charts turned to overweight small and mid-cap stocks, underweight large stocks. And all of these strategic allocation pies out there always put you into the large cap stocks as an overweight because they believe that's the safest place.
Because there's more of them. Yeah, and they believe it is the safest place. And all your consultants at these companies pay big money to come in and say, okay, what are we going to have for options in our plan? They all base their selection criteria on historical performance. So going into March 2000, what was the best performing asset classes?
The big ones.
The big ones.
Sure.
They overweight. I've seen plans down with 9 options. By ERISA law, you have to have a money market, a bond fund, one small or mid-cap fund, and one international fund. So you could have a minimum of 4 funds or 5 funds. I've seen 7 or 8 or 9 fund menus have just that one basic other fund, and the rest are large cap. So that's what people gravitate towards.
Well, to give you an example of what happened here from 1980 on, the day my children were born, each one of them, I opened a stock account for them.
Yeah, I remember.
The day they're born.
I remember that.
My oldest son, Thomas, who's 23 now, he's born 1987 in August, and I bought him Coca-Cola.
Coca-Cola.
I didn't have any money back then, you know, and I had about $600, and I took $600, bought him Coca-Cola, and then I bought some Alcoa.
Okay.
Not much, because I didn't have much money. I may have put $1,000 in the whole thing. And then I just sat with that for 18 years. I didn't sell Coca-Cola or Alcoa until the relative strength chart turned negative in Coca-Cola. And the long-term trend line finally broke in 1999. I sold that stock upwards of the 60-something. And my average cost was probably less than $1 if
Wow.
you take into consideration all the splits.
Yep.
But if you look at that chart going back 35 years, you've got Coca-Cola basically going straight up, and that's the whole period of time that these people that have been in there for, everything's
Exactly.
been nice, just relaxed,
Yes.
big cap stocks,
Absolutely.
Coca-Cola. And when it finally broke that trend line in relative strength turned negative, that's when I got out.
Mm-hmm.
And just last weekend, Warren Buffett said in Barron's, gee, I wish I would have sold Coca-Cola.
Exactly.
And if you look at the trend of that stock from that point forward, when
Right.
the trend line was broken, the relative strength chart was broken, it's a
Exactly.
consistent series of just punch up Coca-Cola and hit PDF chart.
Right.
And you'll see
Yep.
exactly what I mean. And in seminars I do now, that's one of the ones that I like to put up there early. And I say, tell anyone, if it's a customer seminar, if I sent you this chart, or your broker sent you this chart in email, and you looked at this, is this something you'd want to buy with unbridled enthusiasm? Would you want to even have this in your portfolio?
Right.
And they're not even chartists at that point in time, and they can see that there was a major change that took place here.
Right.
And the answer is no, I don't want that.
You don't want that. No.
But a lot of fundamentalists still hold that stock, and they've written it up and they've written it down.
Well, didn't I send you an email a couple weeks ago about Buffett said something about Pfizer? Or the drug sector?
The drug sector.
The drug sector,
Right.
he said something about just a couple weeks ago.
I think he was favorable on it.
Yeah, it was the day that it reversed to a column of O's on the BP's chart.
Mm-hmm.
Yeah, and so he better learn how to read a chart. I mean, he's got some issues.
Well, he's done extremely well fundamentally. I mean, it's been a great time for markets, and when you can buy whole corporations instead of the stocks.
It's a lot different game.
It's a little bit different game, but
Right.
I take nothing away from him. He's just been on an absolutely fantastic job. But when you start looking at things that he says now, that gee, I wish I would have sold Coca-Cola, and you think to yourself, if I could have only gotten a hold of him
Yes.
and said, let's sit down and look at this, if there's a major
Right.
change taking place in the stock, especially when the relative strength charts are turning negative.
Yes.
For the first time in multiple years, it's telling you something about
Exactly.
the underlying stock.
Yep. But that's how you do the 401k stuff.
But that's
Same
where you
thing.
had those big cap stocks running at that
Yes.
point in time, and the major call that you could have made back in October of 2000, that if you made this one call
on the defensive side,
exactly, and said, look, get into small cap stocks and
on
away
the
from
offensive side.
on the offensive
a few months
side.
Those
Exactly.
two calls, Tom, you're in the upper 1%.
So I'm going
of
to
all managers.
overweight your small cap, underweight your large
Large
cap.
cap.
You have earned your fee for
the rest
decades.
of your life with the client.
Yeah, for decades.
And I literally have done that with when you get into plan balances 600,000, 800,000, million too, like that. You can one call like that. When I've talked to a lot of guys. You know what? They think they're taking a lot of diversification, going a third, a third to S&P, a third, and then the other two thirds clone S&P. That's not any diversification.
No,
At all.
and
And
they don't
you
even,
run into
they don't
those
even
people.
realize that. And funny thing about when you talk about relative strength and using relative strength with 401ks, you want to drive as straight a line as possible. I wrote an article a ways back called the Dale Earnhardt School of Investing.
Right.
And my thought process there was, once Dale Earnhardt, when he was alive and he won the Talladega 500, he said, Dale, how did you do it? And he said, well, I was eating Slim Jim all the way around, drinking Pepsi-Cola, and I used STP in the car, and I had Goodyear tires. I said, wait a minute, Dale, how'd you really do it? And the answer is, I drove a straighter line than the rest of them. And that's how you win in investing, is just drive as straight a line as possible. Not jumping back and forth, not trading back and forth. But once you have the longer-term macro picture of something, it typically stays for a good while.
It does.
Now, when you look at that change in small and mid-cap stocks, that's been in existence now for years.
It has.
If you look at the portfolios that we manage now for
iShares?
no, not the iShares. I just went blank for a second.
Right.
It's the nationwide
Nationwide, right.
insurance,
Yeah, variable
utilizing
annuity.
the variable annuity,
Right.
where we watch the store and the mutual funds that are inside the variable annuity.
Right.
Our average holding period for the sectors that we're in there is upwards of a year.
Yeah, absolutely.
So this is not something that we
No.
trade back and forth, which is why the beta in this program that we have is so low. We've got a 0.5 beta, and our holding period is a very long time, because relative strength is something that allows you to
Yes.
drive as straight a line as possible. So when we have a holding period of a year, there's no trading going on
No,
there.
not at
I mean,
all.
the average holding period.
Suitable for any client that you'd sell it to.
Exactly.
When it has a holding period for that length of time.
Let's flip to another